This is Nightly Business Report with Tyler Matheson and Susie Gehring.
Out of hiding, new data show people are spending again, and sentiment is upbeat. Is this the start of a consumer revival?
I demand. Apple says pre-orders for its new iPhone hit a record, and now the wireless carriers are fighting tooth and nail to win your business, but at what cost to them?
And big week ahead. Rest up this weekend. 3 key events next week to keep investors on edge. We have all that and more tonight on Nightly Business Report for Friday, September 12th.
Good evening, everyone, and welcome. A modest stock sell-off today put the final nail into a down week for equities. Their first after 5 straight weeks of gains. Wary investors sent the major averages lower despite good news about consumer spending and a strengthening U.S. dollar. Investors lightened up on stocks as Treasury yields moved higher and crude oil and prices on other commodities continued to slide. At the closing bell today, let's run through some numbers. The blue chip Dow stocks down 61, the Nasdaq skidded 24, and the S&P drifted lower by about 12. For the week, the Dow was off about 1%, Nasdaq off a fraction, and the S&P down more than 1%. As for the dollar, it strengthened against other major currencies for the 9th week in a row. A big factor in today's slide, caution ahead of 3 big market-moving events next week. 1, the latest policy meeting by the Federal Reserve on whether and when to begin raising interest rates. 2, Scotland's independence vote, which could send currencies and markets here and around the globe into turmoil. And 3, the initial public stock offering for Alibaba, the Chinese e-commerce giant, which is expected to be the biggest IPO in history. We have 3 reporters taking a closer look now at each event. Steve Leisman on the Fed, Michelle Caruso-Cabrera on Scotland, and Kayla Tausche on Alibaba. We begin with Steve and the Federal Reserve.
It could be a September Fed meeting to remember. The central bank is 1 month away from ending its bond purchases or quantitative easing program, and there's some speculation it could take steps at this next meeting to clear the way to eventually raise interest rates from their current level of 0. All the focus will be on 2 words. The Fed's policy statement says they will wait a, quote, considerable time from when it ends QE until it hikes rates. They can't raise rates until they get rid of those words, and there's some guessing that those words could go as soon as next Wednesday's policy announcement. Many on Wall Street put the odds at about 50-50. If they do go, then the speculation is that could mean earlier rate hikes than the market now expects, maybe in the spring of 2015 as opposed to the summer. For Nightly Business Report, I'm Steve Leisman.
A key event next week is the Scottish vote for independence.
Scotland says no!
Will the Scots decide to end their more than 300-year union with England as part of the United Kingdom? The latest polls show the vote is too close to call, and the turnout is likely to be extremely high, perhaps record-breaking. The British pound has suffered on the news that the United Kingdom is not so united, and the campaigning on both sides of the question is intense. The supporters of independence say Scotland will be economically stronger if they break away. The No campaign says Scotland will suffer economically if it goes out on its own. Nearly all the banks headquartered in Scotland say if the Scots do vote yes for independence, they will relocate their headquarters to London because they feel the need to be certain that they will remain protected by the Bank of England rather than face the uncertainty of what Scotland is going to do about its currency, which isn't clear. The leadership of the European Union extremely nervous about the vote. They fear if the Scots vote to leave, it will embolden other separatist movements like either Catalonia or the Basque regions in Spain, or parts of northern Italy, which have long agitated for independence. In other words, they fear it could lead to the unraveling of a union that they've worked so hard to keep together. For Nightly Business Report, Michelle Caruso-Cabrera.
Demand from investors for hotly anticipated shares of China's e-commerce giant Alibaba is stacking up ahead of the company's IPO next week. Nearly 40 large money managers have put in orders for more than $1 billion worth of Alibaba stock. Now, of course, they will only get a fraction of that, but the company had only said last week that it wanted to sell about $20 billion in stock. So you can see that we are already at multiples of what the company had planned to sell. That could lead proceeded to price the IPO above the expected range. The company had outlined a range of $60 to $66 a share. Now, here's why investors are so interested in this deal. Number one, because of its growth. Profit has tripled year over year. And number two, because of its size. Profits of nearly $2 billion in the most recent quarter and margins of nearly 70% make this one of the best capitalized and fastest growing names in the tech market. Not to mention they do more business than Amazon and eBay combined. That, along with the size, is leading to this to be the largest IPO in the U.S. or globally and in the technology sector ever. It looks set to best GM's record of selling $20.1 billion worth of stock in 2010. For Nightly Business Report, I'm Kayla Tausche in New York.
Nick Colas joins us now to tell us what those three big events that you just heard about will mean for the markets next week. He's chief market strategist at Convergex. So, Nick, which one is the most important and why?
It seems very much that the Federal Reserve meeting next week is the most important thing for markets as we go into the new week. The reason for that is interest rates. We've already seen interest rates on the 10-year Treasury go from 2.3 to 2.6% just in the past 5 trading days. Higher interest rates tend to slow the economy. They reduce the amount of houses purchased or cars sold. And so that's really top of mind for investors going into the new week.
Nick, does it really matter whether the Federal Reserve raises interest rates in March or whether it does it in May or it does it in July?
You know, the tough thing about calling interest rate cycles with the Fed is you're never really sure where they're going to stop. All you know is that as soon as they start, they're going to keep going. And the sooner they start, potentially the longer rate cycle we have. All of those create uncertainty for investors. And if there's one thing Wall Street hates, it's uncertainty, particularly about the Federal Reserve.
All right, so tell us about this vote in Scotland or Alibaba. Which one is the next, big issue for investors?
You know, the next most important is clearly the Scottish vote. This is something that institutional investors tell me they did not see coming until just 2 weeks ago when the first polls came out indicating that Scotland might be actually ready to leave the United Kingdom. So that's been a big surprise for investors, and it's driven a volatility in the currency market, which is, again, not good for Wall Street.
Let's talk a little bit about what it could mean if Scotland secedes from the United Kingdom.
It's a very tough question to answer because it's basically like breaking up a 300-year-old marriage. You don't really know what the contours of a new Scotland would be. The upshot for investors, however, is a little more straightforward. It'll create a lot more uncertainty in the European economy, and that'll dampen earnings for companies that have European operations. In the S&P 500, for example, fully 20% of revenues and earnings come from Europe over a cycle. So impinging on that growth will hurt earnings here at home.
Nick, we know there's going to be a great voter turnout for that Scottish vote. Any prediction on which way you think it's going to go?
You know, my bias is to think that they're going to vote no, that they don't want to leave the United Kingdom. But it's such a close toss-up that I think you're going to see a lot of investors stepping to the sidelines next week awaiting that vote.
Let's talk Alibaba a little bit. You know, you put together initial public offering, you put together internet stock, you put together Chinese stock, and you got a lot of risk. That said, you got a lot of demand for this company. Is this the kind of stock? Obviously, most individuals aren't going to get a nibble at this on the open, but on the first day, they might be able to buy it. Should they?
I'll tell you, IPOs are very risky for a whole variety of reasons, and you touched on a lot of the important factors related to the risk of the company and the sector. So every investor's got to come to their own decision about how optimistic they are about Chinese internet growth. The one thing I would say, though, is that it is kind of a silver lining in all the negatives we've talked about, that the capital markets can absorb the biggest IPO of all time and still maintain a very strong level of stability. So where the first 2 points were negative, this IPO is kind of a positive.
And real quickly, is that a positive for the markets, too? Do you think that if it's a successful offering on, I guess, Friday, will the markets rally on that?
I think very much it will be a sign of just the strength of overall interest in stocks. All our color from our investor base is that Alibaba will price well and trade well, and so it does seem like a positive.
All right. Thanks for all that insight. Thank you so much. Nick Colas with Convergex. And on that Alibaba news that we just mentioned, Yahoo, which owns a large stake in the company, hit its highest level in more than 8.5 years $42.88.
And more now on that good news about the U.S. consumer. Retail sales in August rose 0.6%, with blowout auto sales helping lift overall spending and lower gasoline prices, giving Americans more money to spend on other things. Department store sales were a bit weaker, though. Also out today, a fresh read on consumer sentiment for September, which notched a little bit higher, and that was a bit above forecasts.
So with Americans spending more money and the dollar getting stronger, how could that factor into the Federal Reserve's take on economic growth just ahead of next week's policy meeting on interest rates? Steve Leisman is back with us, looking for some answers.
The U.S. consumer looks to be making a comeback. Retail sales surging in August, the best number since April, as Americans bought copious quantities of cars, furniture, and electronics. Most important, the same report, which originally showed there was no retail spending growth in July, was revised upward to a healthy positive, showing the consumer did not, in fact, disappear in the middle of the summer.
Income growth is improving. Jobs are up, but income growth is improving. Consumer sentiment is up, and certainly the wealth effect. Both home prices and the financial markets are up in terms of value.
And it looks like the strength could continue. Gasoline prices are down almost 2.5% compared with a year ago, which is like giving every driver a tax cut and freeing money to be saved or spent on other discretionary items. Another positive, a strong dollar should lower the cost of imports just as stuff starts coming in for the Christmas selling season. So those French wines and foreign-made toys could be just a bit cheaper. The main trouble would be if better growth prompts the Federal Reserve to come off as zero interest rate policy sooner, increasing consumer interest rates.
All the economic numbers we've seen in the last month have really been adding to growth. We now think we'll do about 4.5%, an upward revision to 4.5% for Q2, probably 3% growth for Q3. And this lift up in economic growth, I think, really should accelerate the Fed's timetable here.
None of this is to say the U.S. economy is definitively out of the woods of the financial crisis yet. There's still a long way to go, but it's hard to imagine getting there without healthy consumers, and they look to be doing just fine at just the right time. For Nightly Business Report, I'm Steve Leisman.
And speaking of the Federal Reserve, it's making some new moves today to protect the nation's financial system. Vice Chairman Stanley Fischer has been tapped to head up a new financial stability panel, which will monitor specific markets, including real estate or equities, before they get too hot and before they threaten the nation's financial stability.
America is getting older, and that impacts how many of us work. Economists at the Federal Reserve and the Cleveland Fed say that the decline in the U.S. workforce participation rate since the start of the financial crisis is due in large part to the aging U.S. population, not maybe so much to weakness in the economy overall. The findings also show that even if the labor market improves, a larger number of aging Americans are expected to just stop looking for a job.
U.S. Treasury yields have been inching higher, rising for 7 straight sessions and now sitting at a 2-month high. Those higher rates are putting a lot of pressure on emerging markets, especially ones that rely heavily on foreign capital for growth. Many emerging markets posted sharp declines this week. Looking at the market reaction in the countries most affected, Brazil and Turkey down 8%, South Africa falling 5%, and Russia and Indonesia both off by 4%.
The White House released details today of its intensified sanctions against Russia for its actions in Ukraine. The new measures target Sberbank, Russia's largest bank by assets, as well as limiting a major Russian arms maker's access to the U.S. debt markets and restricting U.S. companies from dealing with Russian energy companies involved in deepwater Arctic oil drilling. Cutting off Russia's access to U.S. oil giants may be part of the reason ExxonMobil shares fell more than 1% today. That made it the worst performer on the Dow Jones Industrial Average.
Still ahead, looking to invest in dividend stocks for the long haul? Our Market Monitor guest has a list of stocks that you might want to consider buying for your portfolio.
It looks like Apple has another blockbuster on its hands. Apple says it has received a record number of pre-orders for the new iPhone 6 and the iPhone 6 Plus. Although the company didn't release figures, demand was so heavy on the Apple Store's website that parts of it choked up for several hours early this morning. The phones will be delivered on September 19th, but there are already reports of possible shipping delays due to that steep demand.
Well, those two new Apple smartphones are already shaking up the telecom industry as the nation's biggest wireless companies fight to sign up more customers who want those devices. Morgan Brennan takes a look at what's at stake for the big phone companies with the iPhone 6 models hitting stores in just 1 week.
America's biggest wireless carriers are using the iPhone 6 launch to battle it out for new subscribers, slashing service prices, offering installment plans with no contracts, and shelling out top dollar for trade-ins of older models. Verizon, AT&T, T-Mobile, and Sprint have all rolled out aggressive offers, making big bets that those incentives will be balanced out by the smartphone's success.
We've been pretty clear. We think it's going to be the most successful launch ever of an iPhone, and we're the only carrier that's putting our own rate plan only for the iPhone. So you can bet that we feel very comfortable with the iPhone. I mean, we've made it simple, $50 only with an iPhone 6.
For Sprint and its rivals, this iPhone launch will play out much differently than previous ones. In the past, carriers would subsidize devices in return for a 2-year contract that limited upgrades and imposed a cancellation fee.
Now, you've got carriers like T-Mobile and now Sprint who are willing to buy out all the early termination fees from contracts on Verizon or AT&T. And that means that customers are free to leave and free to shop for lower price plans. That's putting pressure on everybody's pricing, and you're seeing all these promotions in the market that make it easier to upgrade your phone much more often and to do it at a much, much lower cost.
Carriers have also begun offering installment plans, swapping contracts and subsidies for monthly payments by consumers buying the phone at full price. All of this is fueling the market for previously used iPhones. Bernstein Research said it expects the trade-in market to quadruple by 2018. How all of this impacts carriers' profits, though, is up for debate. Some analysts say popular installment plans will boost revenue even as service prices drop. Others, like Moffett, think financials will come under pressure from two directions as folks choose subsidies amid those lower prices. But whatever the final outcome, there's already a winner: consumers. For Nightly Business Report, I'm Morgan Brennan.
Darden posts a loss amid pressure from an activist investor, and that is where we begin tonight's market focus. The Olive Garden parent just managed to beat on the top and bottom lines, but Starboard Value, which owns nearly 9% of the company, isn't satisfied. The activist is pressuring the restaurant operator to increase its profit and its stock price. It had 300 pages of slides of advice for the company, including salt the pasta water and go easy on the unlimited breads. That they needed an activist investor to tell them this? Mama could have given them that advice. Shares slumped 1.5% to $47.58. AT&T's deal to buy DirecTV reportedly being examined by a number of state attorneys general. The investigation of the proposed $48 billion deal will look into possible anti-competitive issues. Shares of both companies lower today. AT&T down 1%, $34.50 the close. Direct was off slightly at $86.85.
Alliance Data is hoping to bolster its digital marketing business by buying Conversant for more than $2 billion. Alliance manages credit cards and loyalty programs for retailers. Conversant offers online ad services. The deal is expected to close by the end of the year. Conversant stock soared 30%, closing at $34.80. Alliance rose 2% to $257.91. And an update on that possible cyber attack at J.P. Morgan. The bank said it has yet to detect any unusual customer fraud related to the recent alleged attack. It reiterated that customers won't be liable for unauthorized purchases. Shares of J.P. Morgan rose slightly to $60 and change.
Our market monitor tonight is Chris Orndorff. He's Senior Portfolio Manager at Western Asset Management. Chris, good to have you with us.
Thanks, Tyler. Great to be here.
You know, we began the broadcast tonight talking about three issues that are on the horizon for next week. You heard it, I'm sure. What would you be telling investors about the climate next week?
Well, I think in the near term, the positive momentum is still going to continue. The economic data releases, as we saw today by the really strong breadth of the retail sales number that was released today, that momentum continues to be positive and consistent with a 2.5% earnings growth rate. You're going to see geopolitical flare-ups like Russia, Ukraine, like Scotland, UK, and those typically, we believe, will create buying opportunities rather than a change in the market direction fundamentally.
So let's talk about some buying opportunities. You have a couple of stocks you want to tell our viewers about. The first one is Ship Finance International. Tell us about this one, $18.49 today.
Sure. This is a company that owns and charters out ships. It's a great play on the improving global growth environment. We also believe that in an environment where Russia is playing games with its energy exports to the rest of Europe, there's likely to be an increased demand for the transportation of liquefied natural gas, or LNG. And this company, that's a positive catalyst that will benefit this stock. And with an 8.5% dividend yield, it pays you to wait.
All right, let's move on to your second one, which you like ships, and your second one is Two Harbors. You like ships and harbors. Two Harbors Investment Corp. What's going on with that one?
Well, the consistent theme on all these is income, which I think is important in this kind of an environment. We expect, as the Fed starts to raise short-term interest rates in the first half of 2015, that's going to be a headwind on stocks. And so investors who are focusing on stocks with positive and high income, or investments with positive and high income, are really going to, we think, weather it better. So this particular company is a mortgage REIT. The dislocation and the change in the mortgage market since 2008 has really created an opportunity in these kinds of entities. And a mortgage REIT has more flexibility than a mutual fund, so it can deliver really very high, and in this case, double-digit dividend yields. Western Asset Managers is a REIT just like this. They're great opportunities, and in this kind of an opportunity where you've got double-digit yields, you really just want share price stability.
Mm-hmm. All right. Your next pick is also one of those with a high dividend. Mercury General Corp, MCY is the ticker symbol. What's attractive here?
Right. This is a property casualty company primarily focused on automobile coverage in California. They're branching out to other states, though. There are also some other positive catalysts. It's a very closely held company. It pays a 4.5% dividend yield. And again, it's a nice place to wait out that anticipated rise in short-term rates.
You going to try and buy any Alibaba next week, Chris?
No, I think we'll wait till the dust settles on that.
All right, Chris. Remember, salt the pasta water and go easy on the breadsticks, as our last segment said. Chris Orndorff with Western Asset Management. And coming up, hidden potential as housing enters the traditionally slower fall season. Some are going the extra mile to sell a home that may need a little fixing up.
General Motors issuing a rare stop delivery order on its brand new 2015 Chevy Corvettes. It's one of GM's most popular models, but the automaker says it needs to fix up some minor problems with the car's airbags and parking brake.
And finally tonight, selling high-end real estate in top housing markets is getting, of course, more competitive and more technical. Simply staging a multi-million-dollar home isn't enough anymore, so some agents are doing virtually everything else. Diana Olick has the story.
This four-story townhouse in Manhattan's sought-after West Village will surely sell at a premium, but getting top dollar will take something extra, because this is what it looks like on the inside.
There's a lot of clients out there that could see through that and have a vision and be able to buy property based on line of sight and see where it could be. But there's others that can't see through that.
So real estate agents at the Halstead Company did a virtual gut renovation and added it to the web listing, still showing the before pictures of the living room, but then the stunning, sleek after. And of course, what everyone wants to see, the kitchen, both before and then after. All thanks to the vision of a real architect on a virtual platform.
Especially in the New York market and markets where there are foreign investors coming in, where they're not actually going to see the property. It's more kind of a statistic.
The agents briefed Chang Zadarov on the potential buyer pool and what kind of renovation that buyer might want to see.
The broker is a local expert. They understand the community, they understand the architecture, they understand what belongs in that property to help sell it.
It clearly comes at a cost to the agent, but in a market like Manhattan, it takes more than baking cookies to compete for a listing. And the agents say it's already paying off. Leone claims web traffic to this listing jumped 30% after they added the virtual renovation. Halstead is far from alone. Another competitor, Reba Miller, debuted a virtual open house for a $10 million property on the Upper East Side. You can choose a room and walk through it. Virtually impossible not to get drawn in, and agents say that's the best way to get you in the real door. For Nightly Business Report, I'm Diana Olick in New York.
To read more about how real estate agents are turning to virtual renovations to make fixer-uppers more appealing to buyers, head to our website, nbr.com. I'm not sure I want to see the way it might look. That looks like a high expense to me.
Yeah, I was going to say that they don't say anything about how much that new kitchen or that new living room with all that beautiful furniture is going to cost you.
Imagine how great this might look if you had another $500,000 or whatever it was.
That's Nightly Business Report for tonight. I'm Susie Garrow. Have a great weekend.
And I'm Tyler Matheson. Thanks for joining us. Have a great weekend, and we'll see you back here on Monday.
I'm Susie Garrow with a Nightly Business Report news brief. Wall Street put the brakes on 5 straight weeks of gains with a sell-off today. Despite a solid rise in consumer spending in August, a bump up in consumer sentiment this month, and a stronger U.S. dollar. By the closing bell, the Dow lost 61 points, the Nasdaq was down 24, and the S&P lower by about 12 points. Nervous investors sold out of stocks ahead of next week's Federal Reserve policy meeting, Scotland's vote on independence, and the IPO of Chinese e-commerce giant Alibaba, expected to be the biggest in history. And Apple says it's received a record number of pre-orders for the new iPhone 6 and the iPhone 6 Plus, enough to crash its website for several hours this morning. Be sure to tune in to Nightly Business Report right here on your public television station.